हेलो, अगर आप मेरी वीडियो पहली बार देख रहे हैं तो मैं हूं कृति और मैं इस चैनल के माध्यम से यूजीसी नेट मैनेजमेंट से जुड़ी इनसाइट्स और उससे रिलेटेड एमसीक्यूज प्रोवाइड करती हूं। प्रीवियस वीडियो में जो हमने डिस्कस किया था, टाइम वैल्यू ऑफ मनी, इम्पोर्टेंस, टेक्निक्स एंड रीजंस, वी ऑल्सो स्टडीड अबाउट रिस्क एंड रिटर्न्स, फैक्टर्स कॉजिंग रिस्क, टाइप्स ऑफ रिस्क, its measurement and related MCQs. To stay updated with the recent videos, please subscribe to the channel and press the bell icon. In this video, we will discuss about risk and return, CAPM, that is Capital Asset Pricing Model, SML, that is Security Market Line, CML, Capital Market Line, APM, Arbitrage Pricing Model, and related MCQs. So, types of risk, systematic and unsystematic risk. We have already studied this slide on the previous session. To know more about it, please visit on the link in the description or subscribe to the channel. Summarizing risk, I will say that it is a possibility of loss जो हम एक्सपेक्ट कर रहे हैं, रिटर्न्स हो या रिजल्ट्स हो, और जो हमें एक्चुअल में मिलता है, उस डिफरेंस को रिस्क कहते हैं। रिस्क को डिवाइड किया गया है दो पार्ट्स में, सिस्टमेटिक रिस्क और अनसिस्टमेटिक रिस्क। रिस्क जिसको कि हम डाइवर्सिफाई कर सकते हैं उसको कहते हैं अनसिस्टमेटिक रिस्क। फॉर एग्जांपल, रिस्क एसोसिएटेड विद अ पर्टिकुलर कंपनी और एनी इंडस्ट्री। और रिस्क जिसे हम डाइवर्सिफाई नहीं कर सकते हैं उसे कहते हैं सिस्टमेटिक रिस्क, जो कि पूरे इकोनॉमी वाइड होती है, जैसे कि इन्फ्लेशन रिस्क, interest rate risk, etc., as you can see in the slide as well. इसमें हम सिस्टमेटिक और अनसिस्टमेटिक रिस्क के एग्जाम्पल देख सकते हैं, such as systematic risks are market rate risk, interest rate risk, purchasing power or inflation risk, natural disasters, changing consumer perspectives, and unsystematic risks are financial risk, business risk, employee turnover risk, employee strike, or any operational risk in a company. Risk preference. Suppose there is a lottery of say 1 lakh. In this, you have three options. First option says that either you lose, it means you are getting zero amount, or 1 lakh if you win. It means if you will lose, you will get zero, nothing. And if you will win, you will get the total amount, which is 1 lakh. While the second option says that you will get 10,000 in both the situation, whether it is a win or loss. Or there is an indifferent choice, which will be a third option. Here comes the importance to understand these three kind of investors. Risk seeker, who will choose option 1, which is risk takers. They will take risk of getting either zero, it means no amount, or getting 1 lakh, the full amount. Risk averse, it means who will choose option 2, which was to get 10,000 in both the situation, who are not willing to take any kind of risk. They are okay to get anything which they are getting without taking any kind of risk. And then there are risk neutral, who will be indifferent to both the situation. तो दोनों के बीच में ही indifferent हो, choose ना कर पाए, वो होते हैं risk neutral. रिस्क सीकर जो इंडिविजुअल्स होते हैं वो रिस्क लेना चाहते हैं, दे सीक फॉर द रिस्क. रिस्क एवर्स जो बिल्कुल भी रिस्क नहीं लेते और जो इनडिफरेंट होते हैं, इन दोनों के बीच वाले, उनको रिस्क न्यूट्रल इंडिविजुअल्स कहते हैं. सो दिस इज ऑल अबाउट रिस्क प्रेफरेंस. नाउ measurement of risk. We have studied this as well on our previous video. The risk can be measured using various techniques as been listed on the slide. probability distribution, standard deviation of returns, coefficient of variables. The formula for a probability distribution is the sum of product of possible returns and their probability. Standard deviation of returns refer to the deviation or dispersion of returns from an expected value, while the coefficient of variables CV measures the risk per unit of expected return, and it can also be expressed as coefficient of returns. And this can also be expressed in the formula where coefficient of variables CV is equals to standard deviation SD divided by mean. Here we have an example of two asset case. In the state of economy X and Y, the probability and possible returns for A and B are given in a tabular format, as we all can see on the slide. The formula to calculate expected return is this: ER is equals to probability multiplied by the possible return of A plus probability plus the possible return of B. Now, I suggest you all to calculate the expected return for A and B using the formula given in front of you in the slide. I hope you all must be calculating it. For ER of A, you will take probability 0.5 multiplied by 40 plus probability of 0.5 multiplied by 0. So, the expected return of A would be 20%, while for B it would be 20% as well. If anyone have any kind of doubt, please post it in the chat box. Anyone? Supposing that it is clear to you all. In this, with reference to the previous slide, we are asked to find the variance. The possible returns or probability will be the same as it was in the previous slide here. And formula to calculate variance is already been given to you. Let's see if you can calculate the variance for A. Variance of A would be that it is clear to you of 0.5, which is a probability, multiplied by RA, which is given to be 40, minus the expected rate of return, which we have calculated to be 20 to the power 2, which is square, plus 20 multiplied by 0 minus 20 to the square, which is 400. So, the variance for A would be 400. Anyone, any doubt? Please post it in the chat box. And the standard deviation, which is the square root of variance, will be the square root of this 400, which is 20%. So, the standard deviation of A is 20%. Now, we need to find the variance and standard deviation for B. And you all will find this, the variance and standard deviation of B, and post it in the chat box. Let's see who gets the correct answer. Now, covariance. What is covariance? It is the measure of direction of relationship between two variables. Suppose there are three numbers A, B and C. In A, increase in expenditure in advertisement. Yes. So suppose there are three companies A, B and C. Now we are talking about A. In A, with increase in expenditure in advertisement, sales increases. So it means with increase in expenditure in advertisement, the sales is also increasing. This means that there exists a positive covariance between the variable advertisement and sales. While in company B, with increase in advertisement, the sales volume is decreasing. This means that there is a negative covariance between these two variables, which are advertisement and sales, in the direction of increasing or decreasing. And if the direction of increase or decrease in the first variable, which was advertisement in this case, does not have any effect on the second variable, which was sales in this case, it is said to be as zero covariance, which is about the company C. तो वेरिएंस को कैलकुलेट करने की फॉर्मूला आपको स्लाइड पे दी हुई है, आप यहां से रेफरेंस ले सकते हैं. Now we have this question in which we have possible returns with respect to the probability, और हमें कैलकुलेट करनी है एक्सपेक्टेड रिटर्न, वेरिएंस and standard deviation. I will do calculation. In the meanwhile, if you get any answer, please do post it in the chat box. Now, I have calculated this in an Excel sheet so that you can get reference.